Yes.
Thank you, my Lord and my Lady. I was making submissions regarding the table, as we're calling it. And the submissions I've made so far is that universal life insurance is a market-recognised form of life insurance with well-defined features which distinguish it from other standard form policies. And those features were explained to the appellant by his insurance advisor. And I made the point that the policy illustration factored in the increasing guaranteed cost of insurance. And we submit that if the exercise had been done for the policy illustration to show that the account value would go up to a certain age and then decrease again, then the likelihood is that it would have been done for the policy as well. The policy refers to the table of guaranteed cost of insurance charges in three places. At page 490, you can see the table of contents. The policy itself starts a few pages earlier. 490 is the end of the table of contents. There is a reference to the table of guaranteed cost of insurance. And on page 500, there are two provisions on page 500. At the top of the page, guaranteed cost of insurance is the heading. And again, there is a reference to the table of guaranteed cost of insurance. The monthly guaranteed cost of insurance is 1/12 of the rate shown in the table of charges at the end of this policy.
Which page are you on?
That's page 500 at the very top, my Lord.
500, sorry.
So I started with 490, which was just the end of the
Yes, I have that.
table of contents, which referred to the table of guaranteed cost of insurance, and we have an express reference to it on page 500 as well in the first provision, the guaranteed cost of insurance provision, which says the monthly guaranteed cost of insurance is 1/12 of the rate shown in the table of guaranteed cost of insurance charges at the end of this policy, which ties in with the table of contents that would appear at the end. And in the next clause, the change in cost of insurance clause, there is also a reference to the table of guaranteed cost of insurance charges. This is the option to change from a yearly renewable rate to a level rate. It says if the guaranteed cost of insurance rate for the primary life insured is yearly renewable term, you may request it be changed to the level rate applicable to his or her attained insurance age in the table of guaranteed cost of insurance charges. So again, there's another reference to it there, but it also gives us some indications to what the table would have included. There would have been various figures set out relating to the attained insurance age of the primary life insured.
So are you saying then that the table, if it existed, would have included what the level rate would be if at any point you chose to convert to that?
Yes, it would have included both for the yearly renewable rate and also the level rate, all based upon the attained insurance age, because that's the material factor that would be changing. The appellant would be increasing in age from year to year. He'd remain a non-smoker, presumably he'd remain male, presumably at least for insurance purposes. So we submit that if the table had not been provided to the appellant, the likelihood is that he would have noted that and he would have asked for it. He would have wanted to see the guaranteed or maximum rates of the cost of insurance, because those were material, as he submits, to the value of the balance in his investment account.
It's also referred to at page 508, where there's an option to have another life insured, and that other life insured comes in. So if his wife wanted to join in the policy or whatever, there you have the table being referred to again.
You do. Thank you, my lord. It's both provisions at the top of page 508, the
Yes.
guaranteed cost of insurance provision and the changing cost of insurance provision,
Yeah.
on the assumption that there would be, as my lord says, a second life insured. So there are references to the table in the policy, and as I say, we submit that if it had not been provided, the likelihood is the appellant himself would have asked for it. But we also submit that if the table had not been provided to the appellant, the likelihood is that his insurance consultant, who was advising him and who had been familiar with this standard form of policy, would have noted it and it would have been asked for.
Is that a primary finding of fact that you wish us to make, in the absence of any such primary finding of fact made by any of the lower courts? And if so, why?
My lord, all of these points I'm making are directed to the inference I shall submit that the judge made in her judgment. The inference she made is that in the absence of any particular dispute, she inferred that the charges were applied in accordance with the table. And I'm saying that that inference is justified on the probabilities. And the probabilities I've just gone to, that firstly, if the exercise had been done for the policy illustration, which it had done, it would have been done for the policy, the likelihood that the appellant himself would have asked for it, because it's referred to in 5 places in the policy, and his insurance consultant certainly would have asked for it. Although the likelihood of all those matters, it supports the inference, we say, that the judge made in the absence of a specific dispute.
That would be a neat solution to that part of the appeal. But whereabouts does the judge draw that inference in her judgment? I don't want to take you out of your way if you want to come back to it later.
I'm coming to it momentarily. Let me set up that point in this way. As I explained before the short adjournment, the actual rates applied by the respondent were not an issue. The issue was instead one of principle, whether there was a contractual basis for an annual increase in the guaranteed cost of insurance, as opposed to it being a fixed rate, as the appellant has submitted.
You say they weren't an issue, but we have been shown that Mr. McPhee didn't accept that the rates charged were contractually justified. And so there is a question, isn't there, as to who had the burden of proof to show what the contractual rates were.
Yes. Well, perhaps I address the burden of proof now as it's being raised. We say what had been pleaded by the respondent and the evidence adduced by the respondent established the fact of the increases. And the burden, we say, was on the appellant to raise an issue as to whether they were specifically contractually justified and had to adduce some evidence to show that they were not contractually justified. And if he had raised some such evidence, then the respondent would have had to have adduced evidence in response, otherwise the respondent would have lost. My learned friend referred to the shifting of the burden, or perhaps the evidential burden, certainly he made reference to. But the courts have cautioned against the use of that phrase. It's unhelpful to the extent it suggests that the burden shifts from one party to another. It doesn't. The burden was always on the appellant as the claimant.
And why do you say that? Just because he was the claimant?
Because he was the claimant and needed to establish that the facts as established were a breach of contract. That was the premise of his claim, and that was why he was under the burden to establish that there was a breach of contract.
Why couldn't he just say, I have paid X amount of premiums under this contract. I do not accept that you were entitled to deduct anything. and it would then, wouldn't it fall to your client to show that actually there was a debt owing to it, that it was entitled to set off against the debt owing to him?
Well, again, the issue as framed was one of principle, and so yes, the principle was raised as to whether there was an entitlement to set off, a contractual entitlement. But there wasn't any issue raised that the actual amounts...
There's two separate questions. At the moment, I thought we were discussing just where, as a matter of law, the burden of proof lies. And I'm putting to you an alternative analysis. We haven't been given any authority on either side, which is that he had a claim in debt for the amounts of premium that he paid and were as a debt owed to him by the bank. And it was for the bank, if it wished to do so, to establish that it had an entitlement to a cross debt, if you like, which it could set off. And it had to prove both the existence and the amount of that debt.
But
why isn't that correct in principle?
my Lord, the US authorities and the textbook show that when we talk about investment account, we're talking about a notional account. It's not, in fact, an account that is set up. It's a notional account. So the monies, the premiums are paid and they go to the insurer.
Yes, well, any account is notional, if you like.
I think one has to be a bit careful with analogies with banks, because I don't know whether they are a licensed deposit taker or whether that is the basis on which they accept this money. I think you're saying that there's no requirement on them to segregate this money, and they're not regulated as a bank, maybe. So I don't think one can push the analogy with a bank account and the terms of a common deposit taker bank account with this.
I think that's right, my lady. The US cases show that there are very complicated tax implications of these arrangements. Now, I don't pretend to begin to understand those tax regimes, nor the precise regulations that are imposed upon insurance companies who issue universal life policies. So I simply don't...
well, if we don't have any evidence of foreign law, we just have to apply English law principles. So what do you say the nature was if it's not a debt owed to those monthly deductions? Are they a debt owed to the insurer by the insured, which is set off on a rolling basis against the debt that is owed the other way, and there's a balance at any one time?
I think the way the insurance policy is set up, it describes the payments as premiums, and they are payments of premium.
Okay.
And taxed as such.
And presumably taxed as such. And everything that happens within the insurer, although unbundled, which is one of the advantages said to be of these life insurance policies, all of that unbundling, separating out premium and then deductions, is all notional. It's not physical in the sense of actually segregating with an actual account. And so it's not that there's a debt in terms of owing the balance of the investment account. It is simply a rolling account of what premium has been used for which purpose, and what the notional balance is. And so there wouldn't be a debt at any particular time owed by the insurance company to any policyholder.
Okay.
What there would be is a notional value in a notional account as an overpayment of premium in the early years to offset the underpayment of premium in the later years when the guaranteed cost of work, when the cost of insurance, the cost of the death benefit will have increased. So it is entirely notional, and that is made expressly clear. I say the reason it comes to light is because this product, this universal life product, I say one of the advantages was said to be that it unbundled the payment of the premium, the earning of the credit interest, and then the deductions for the monthly charges and the monthly administration charges, and also for the cost of death benefit. But that unbundling isn't physical, real, it's entirely notional, so there's no debt owed at any one time.
So you're really paying in advance later premiums, and those are then saved up notionally so that you're not in breach when you fail to pay sufficient general cost of insurance at some later stage. But it's not a deposit as of the kind that you make when you put money into a bank.
Precisely. And
there's some you do have page 501, you have investment account option provisions. It allows for interest to be paid, and you can make withdrawals.
Yes.
So if you're making a withdrawal, that's definitely a debtor-creditor situation.
Well, I think
it's meant to look like a duck and quack like a duck, but not be a duck for regulatory purposes.
For regulatory purposes. So precisely that. Part of the features of this policy, which I didn't need to go to because the annual increases aren't in play, is precisely covers these points. The flexibility introduced by universal life policies allows a policyholder to build up a cash fund, either to use to supplement the underpayment of premiums later on, or as a fund to take a premium holiday and fund the deductions in the meantime.
As Mr. McPhee did.
As Mr. McPhee did.
Or just to build up some additional amount on top of the life cover.
Yes, at a guaranteed rate of 3%, or possibly, if the market's worked in favour, up to a rate of 6%. So that is the flexibility built into these policies, which is why they were attractive alternatives. The unbundling, the flexibility in terms of timing and amount of premium payments. And the ability to withdraw or to borrow, because some of the policies talk in terms of loans, money from the insurers. So those are all features of a policy, but does it give rise to a debtor relationship? We would say no, it's all notional, all premised upon the policyholder paying the target premium for the life of the policy in order to cover the premiums that will fall due later on.
But if the person dies, there is a debtor situation, isn't there?
There is at that point. There is at that point.
Yeah.
And what's the relevant, in our case, the relevant point is whatever in 2014, is that when we are looking at what the policy was worth? On the basis that whatever money was owing at that point is what was due to Mr. McPhee.
Well, except there was nothing, my lord, because the whole point of the policy lapsing is because there was no notional account value left to pay the monthly charges. So the policy lapsed, and therefore there was no death benefit, additional death.
I thought on your case, well, then he did make a payment, but late. But I thought on your case he was owed $40 or something.
He was owed the return of the premium that he paid late. He was owed
less what he was in debt for. Is that right?
That's right.
So what we do need to, what it all turns on is what was amount owed by him or to him at that time.
Yes, I think in terms of the pleading, but I may be corrected, and this is a point perhaps just helped out, that there was that letter that was sent with a table, a summary table, which had an account balance of $41 odd. There was then explained in the evidence that they went to the respondent's computer records and looked at those and worked out that there needed to be a small adjustments because of the change in premium, the tax on premiums. And so the figure
slightly different. It doesn't matter what it was,
but to one of the points that was raised when my learned friend was making his submissions is whether the paragraph 10 of the amended defence longer table is simply a longer table of the letter. The answer is yes, subject only to those small corrections that were made in relation to premium tax, the amount charged. So the 41 balance went to $53 balance, but otherwise one extended
But
to the end.
that was not sufficient to cover that month's deductions,
No.
but once the policy lapses, he's entitled to that back for what it's worth.
Yes. As I say, and on the facts, because he made another premium payment late, he was entitled to that premium payment back as well. So we say, through all of that the burden is what was very firmly on him.
But just going back to what you were talking about before, the short adjournment of whether this is a maximum, would have been in the table. The table has all sorts of other figures in which might be become relevant, but in fact were never relevant. I'm not quite sure where that gets you in terms of what was the mechanism to which Mr. McPhee agreed for the increase in the annual rate of the general cost of insurance, guaranteed cost of insurance. Because if it's not the table, and you seem to be leading towards a submission, well, it can't have been the table because that's only a maximum, then where is it? Because there doesn't seem to be any other provision in the contract which explains how that annual increase is going to be calculated.
Well, to answer that as straightforwardly as I can, there are assumptions, male, female, smoker, non-smoker being the most important, other than age. And those assumptions were, as I think I mentioned, that they appear in the policy illustration, probably on page 474, which identifies that the appellant was a non-smoker and that he was male. So those risk categories were identified in the policy illustration. One that would change over a long-term policy is going to be the appellant's age. And the relevant factor, therefore, both in the table, but in any event, is what's described in the policy itself as the insured's, so just looking at the exact words, attained insurance age. And you get that from the change in cost of insurance provision. It makes sense in any event by itself that what is changing from year to year when the policy annually renews, yearly renews, is the age of the policyholder. And I took, my lords, my lady, to that definition which was before the Court of Appeal, that what you can't do is increase the premium if there's been a change in his physical condition. But you can change the premium because his age has changed. And that you can
Yeah,
get.
but by how much can you change it? That's the question.
Yes, well, and the way the policies of this sort work is there is a maximum, a guaranteed amount in a table, and short of that, they're increased by an amount assessed by the insurer, having regard to its assessment of the mortality risk. This is the point I made. So the mortality risk for a 70-year-old in 1910, taking an extreme example, was a lot lower than the mortality risk for a 70-year-old today. And what changes is that assessment. There are standard tables for that, which again you can see references to in
They're actuarial tables.
exactly.
And so it's your case, is it, as I understand it, that the insurer was entitled to increase the amount by whatever it thought fit, as long as it didn't exceed the amount in the table?
Yes, subject to whatever amount it thought fit. So there was all insurers have standard tables, and this was the evidence of Ms. Chatlani, who said what there was a schedule of rates. There would be a stream of cost of insurance charges which have increased over the duration of the policy every year as you age. They are set, having regard to risk categories. I do apologise.
The schedule of rates weren't discovered. We haven't got them. We don't know what they contain. and we don't. I mean,
They may vary from one insurer to another. They obviously do.
Well, I don't-
Not everybody uses identical tables.
Well,
So is this what you're saying, that what we should infer from this is that when you take out a policy, you know that it's going to get more expensive as you get older. By how much is all to do with the arcane arts of the actuary, because they have all this data which they produce these actuarial tables as to what the life expectancy is of someone with certain characteristics at a particular age. And that is what you assume that the insurer will use, and they can apply their actuarial tables as long as they don't go above the maximum. So it is, as my lord says, whatever they think fit. It's not arbitrary. It's got to be based on their actuarial tables, and here it seems nobody has ever argued that it isn't, and that's effectively what we should read into the contract to give it certainty if it would otherwise be uncertain. Is that?
Presumably there's a profit element too in the premium. I mean, you're not just you're trying to make money out of the policy, and so you decide as the insurer how much you're going to build in as profit on top of the life expectancy, don't you, when you set the premium?
certainly there's got to be a profit element. But a lot of the cases in the United States courts are class actions directed to the increases in the guaranteed cost of insurance that have been applied by particular insurers, whether it's Phoenix or someone else, because they've taken into account wrong considerations, certainly that's the one I can think of. There was a list of what requirements they can take into account, and they took into account something else. But the principle that it's for the insurer to set is one that is a part of these standard form products. And that's why you have the maximum. I do apologise.
if I understand it, what you're saying is, in accordance with the schedule of rates, they could apply whatever those schedules, whatever the result of those schedules are, provided they don't exceed the maximum contained in the table.
Yes.
We don't have the table.
Yes.
We don't have the schedule of rates. Why is it that the schedule of rates wasn't discovered?
Again, I can only tell you the answer that, as I understand it,
Yeah.
and that it wasn't thought to be relevant. And it wasn't thought to be relevant because of the way the issues were framed. Now, that may be right or may be wrong, but that is the point that I was dealing. And can I?
Sorry, can I just ask one clarification? Do you say that the effect of your client's evidence was that a schedule of rates was applied which was different from, although you say by inference less than, the rates in the table?
No, I don't accept that.
Okay.
So can I just take this run, because it will answer both those questions, hopefully, I hope at least, and if it doesn't, then no doubt you can ask the questions again of me and put me to task. But we say the appellant did not advance in his pleadings a case that, despite the many references to it in the policy, the table of guaranteed cost of insurance charges had been omitted from the policy and never been provided to him. He didn't plead that. And the appellant did not adduce any evidence at trial to that effect. Indeed, although the first instance judge directed that he bring the original contract to court, the appellant did not do so. That is recorded in the judgment, paragraph 61, pages 196 to 197. He did not produce the contract, the original contract, which of course he had the original contract.
I thought you said a moment ago that the one that was in the bundle was the one that he produced.
Yes, so in the bundles, of course, there was a photocopy.
Oh, I see.
And what the judge asked to see was the original contract, to see if there was something more to it. And in the judgment at paragraph 61, he did not do that. He did not bring the original contract to court. And in the Court of Appeal, the appellant again was asked by the Court of Appeal to produce the original contract within 2 weeks of the end of the first hearing, the part heard hearing. But again, he did not produce it to the respondent within 2 weeks. He brought it with him to the resumed hearing on the day of resumption and handed it to the respondent then at the hearing, and then submitted that any omissions or discrepancies did not affect the issues in dispute. And that's in the Court of Appeal transcript at page 367, lines 19 to 22.
Sorry, let me just get that on board.
So there was some discrepancies because the numbering of the policy didn't match the numbering in the index, and some pages didn't appear. And so the Court of Appeal of the Commonwealth of the Bahamas asked for the original and asked for it to be produced to the respondent within 2 weeks. It wasn't produced within 2 weeks. It was brought to the court on the day. And what the appellant said, I have the original assumption certificate and assumption of obligations, which they say would abide from by Canada Life. So that is the letter written by my client, Respondent Colina, accepting that it stood in place of Canada Life as the insurer. And he says, so this is the contract. Those are the discrepancies in the page numbers, and they are of no moment the issue at hand, which is the increase in the guaranteed cost of insurance unilaterally by the respondents. And then over the page, at the top of the page, it continues, it says 368, there is no issue other than that now the respondent has increased the guaranteed cost of insurance. Page 3, the details page, that is the only issue. They assume the contract. So what he's saying there is Colina stood in the shoes of Canada Life, and they were bound by page 3 of the contract, and that's the policy details page, which we can see at page 491. And my lords, my lady, you see just at the bottom of the page, it's slightly obscured, but that is numbered page 3 in small type, just by page 19 on page 491 of the bundle. So he's referring to this, and he's going back to the argument that the monthly deductions of $74.62 are fixed for lifetime. That, he was saying, was the only issue. So it goes back to what he was saying, his construction of the policy. The only issue was a question of construction of the policy. Was he right that the monthly deductions were fixed for lifetime, or were we, the respondent Colina, right that what was fixed for lifetime was the obligation to pay the basic policy insurance cost? And so the duration was fixed. That was to be paid at an initial rate of $74.62, but that was a yearly renewable rate, and it would renew from year to year. So that was a submission that was made by the appellant in the Court of Appeal.
So here in these pages, 367, 368, 369, there's a general discussion about pages missing from the original policy, and when the judge is asking Mr. McPhee, he's saying this doesn't make any difference to anything.
Well, we can take it, I assume, that the table was one of the wasn't included in the document that he came along with to the Court of Appeal.
Well, the table wasn't considered in that discussion at all.
No, but I think if the table had been in the policy, somebody might have pointed that out.
The table wasn't being considered by the parties in the courts below at all. And what was being considered...
Well, are you telling me that the table was in what he produced, the original?
I can't tell you what he produced. The original was, I say, was produced.
Well, Mr. North went through it.
Well, he did, looking at whether page, I say, in the index there were page numbers. There were some missing page numbers in the index, and the question was, did that translate to missing pages in an original policy, or do they simply not exist? And so there was. That's the question they looked at. They were looking at the number page 13, 15, 16, and so on. They didn't turn their mind at any stage to whether there was a table attached.
Yes, the issue, as I understand your submission, that the judge was facing and the Court of Appeal was facing was whether or not the $74.62 was a fixed sum, and that the parties did not focus, knowing as they did that there had been increases, they didn't focus on whether or not those increases were consistent with the policy, if the policy allowed for increases. That I think is the essence of the point. As you're saying, well, maybe the table, it would be much better to have produced the table. Maybe the matter could have been clarified much better. But you say the judge inferred, having regard to the issues put before her, having concluded that the contract allowed charges, that the charges would, the increases in the COI, that the increases charged, which you could see in, for example, page 533, where the insurance company's letter summarises what's been taken off, were in accordance with the contract, because no one had argued by reference to the table or anything else that they differed from the contractual entitlement, because the case you were facing was that there was no contractual entitlement.
Yes, yes, that is my submission. Can I just make one, in a sense, anterior point about the evidence of Ms. Chatdani in response to a question from my Lord Justice Leggett. She explained that the annual increases in the guaranteed cost of insurance applied by the respondent were applied in line with the appellant's attained insurance age. That was her evidence, in accordance with a schedule of rates. And my learned friend has taken you to at least some of the most relevant references there where she was talking about a schedule of rates. He says, well, the appellant was not cross-examined on the table, whether it exists and so on, but nor was Ms. Chatdani. It was not put to her that the schedule of rates to which she was referring cannot have been the table of guaranteed cost of insurance charges referred to in the policy, because it had been omitted from the policy and never been provided.
Well, the gist of her evidence was that she didn't know actually what specific document had been used, wasn't it? Because she wasn't there at the time, and her knowledge was based on the documents that everybody was looking at.
That's right. But she was giving evidence. She wasn't giving first-hand evidence of what she did. What she was doing is giving evidence as to what was recorded in the respondent's computerised records.
Yeah.
And what was the insurer's practice?
And what precisely that was my next point. And what was the insurer's practice? But both in terms of which we'll come to the practice in relation to the reinstatements, but also the practice in relation to the annual increases, what you would expect, in light of these being standard form policies, and how all these standard form policies were administered.
How could she refer to a schedule of rates as opposed to a whole series of schedules of rates? Because these risks change from the inception of this policy until 2014. You'd have thought that in 2008, 2009, there would be different life expectancy tables and so on.
In terms of a whole new table being produced?
She refers to schedules.
Yes.
I assume those are schedules in 2014 when she does the calculation. Okay?
She referred to the annual increases taking place from 2004
in accordance with schedules.
in accordance with schedules of rates, and what she described that as a stream of costs of insurance charges in the schedules of rates. So the stream of insurance charges would say what, as set in, because of course the only factor changing is going to be age, so you can set these tables at the beginning, and so when you turn from age 54 at the outset to 55, you know that's going to change. You can predict what the rates are.
No, but from one year to another, A, the mortality risks estimates might change, and B, the profits that the insurance company, particularly if it's a new company, wants to set might change. These rates aren't set in stone, are they? I thought that was part of your case, isn't it?
I do understand that. So it may be that the actual rates that are being used are the standard form internal company rates, that are being applied.
For 2014 or progressively over the whole period? Because the schedules applied by the insurance company must be different year on year, I'd have thought. And
Yes, they must assess the life expectancy of the insured on the basis of current data, not on the basis of data at the time the insurance policy was entered into.
And they probably want their profit element to go up with inflation.
That might well be right, on the basis of the explanation that I gave earlier and what's going on. And provided those schedules that are being used are less than the maximums, then it's contractually permissible.
Forensically, one would love to see those schedules, because they might say revised 2013 and or subject to an increase. I don't know what they say. I mean, they might declare all sorts of things of interest, but anyway, the opportunity for that's all gone and past.
It is. What we do know is the actual rate that was applied, because those are contained in paragraph 10 of the amended defence. And we can see those, and we can see that they are applied and in August on each anniversary. And my lords, my lady, have already picked up in terms of the increases. They apply once a year. There is that anomalous one that perhaps we can just look at that whilst we're just looking at this point. It's in the amended defence, paragraph 10 on page 18. So this is effectively a record of all the transactions relative to this policy derived from the respondent's computerised records. And what can be seen is that the guaranteed cost of insurance on page 18 initially was the $74.62. And it rises each year. So, for example, on the 9th of August 2004, on page 19, it goes up to $80.25, and someone has helpfully circled that figure, in August 2004. It goes up in August 2005 on page 20 to $86.37, and it goes up each August on the anniversary of the policy, and that is those are the increases that are being applied in line with the schedules within the respondent. But there is one anomalous one which does not take place in August, and that anomalous one is on page 21.
So you say in August? Is it September, isn't it?
It's the American system, as I understand.
Oh, I do apologise. Of course, it is. Yes.
So I think it is.
You're right. You're right enough. Yes, you are, of course.
Because the original policy was issued in August, and so I think the anniversary dates is in August, and it continues. So each August there is the annual increase, and then there is an anomalous one on page 21. You can see that there is an increase. If we look perhaps first at the 9th of June 2006, we can see the rate there is still 86.37. It's middle of the page on page 21.
Yeah.
Guaranteed COI 86.31. On the 9th of July 2006, it goes up to 108.25. And then on the policy anniversary, on the 9th of August, it goes up to 114.75. So the second of those, the increase to 114.75, is the annual increase. The one before that in July, 9th of July 2006, is of course the first, and indeed here only, monthly deduction made after the policy was reinstated in June 2006. So the effect of the plus 75% rating, however that is, can be seen, certainly in terms of numbers, to increase in a one-off way.
And I don't suppose you can explain how 75% uplift gets you from 86 to 108.
Well, it doesn't get you, in a sense, from 86 to 108, because I think the 75 is applied to the original figures somehow. So it would be an uplift to the $74. The rating it's an uplift to the rating that was applied to get to the $74, the original figure. How
still doesn't work mathematically.
No, well, how you get to the $74 from whatever rating led to that I don't know. And
No, but if you take 75% of 74 and add it on to
It's a lot more than
86, it's
108.
still more than 108.
Yeah, well,
I can see that without having to calculate.
it is,
the rise from 86.37 to 108.25, I make 25%.
yes. But,
So
but it may,
but how you get that by applying some 75% rating, we don't know. Perhaps we don't need to know.
no, I mean, if I had a calculator, I'm just trying to do, I don't think it works either, looking at what the increase is from 74.62 to 108. What that is as a percentage increase, I don't know, because that's talked about from the original.
All this creates a bit of a problem, though, when it comes to saying what the requirement was that your client had.
Well, I'll come to that. But what
I think that's a separate argument. At the moment, we're still dealing with increasing costs of the...
it is. But
Right, so
whilst
that
we're
was
here,
the one time that it increased by more than 10%, basically.
it is, and it's the one time it increased on a date other than August,
Yeah.
the anniversary date, and the date it increases, July 2006, happens to be and is after the reinstatement in June 2006. And the point I think my Lady Rose picked up is there were 3 payments of premium, or rather 2 payments of 3 times the premium. So on the 21st of June, there was a payment of 1,056.24, which is 2 lots of premium. And then on the same date, you get another 528. So there are 3 sets of premium coming in there. And just ask you to know that when I come to the plus 75% rating points, I put it, the application of the reinstatement, there is, in this record, payment of 3 lots of premium, which is one of the requirements for reinstatement. So
Well, if they met that requirement, then he failed to make the other requirement. I mean, on any view, he didn't meet all the requirements because you were meant to pay 3 months ahead, as well as getting yourself up to date.
well, that may
He
well
didn't
be
do
right.
that, did he?
And there may well be been a generous approach in a sense, but there is. But let's say I can come back and deal with that in terms of exactly what the requirements are when it's contractually justified. But
While we're on this page, I don't want to take you away beyond this one point from the annual increase argument, but if there wasn't a contractual justification for applying an increase to the cost of insurance by virtue of the lapse and reinstatement, then once you had increased from 86 to 108, presumably the percentage rate increase thereafter would be based on the 108. Would that be right? So each time in the future there was an increase after 2006. It would be an increase on a higher base based on the reinstatement re-rating.
I don't know the actual answer to that, but that is a fair inference, I would say.
I was inferring it from the figures.
On the figures that are there, but I don't know whether. I don't think anyone had asked whether that was in fact the basis. But it makes sense and it can be inferred from the figures.
But no one has done the arithmetic to work out what the account would have looked like if you'd had the annual increase but just stripped out that additional.
No.
Well, there's no actual evidence as to what the actual annual increases were, and
I didn't want to force you into this other
Yeah.
argument at this stage, but just while we were on that page.
Absolutely, but no one's done that exercise in relation to the reinstatement point, because again, that wasn't an issue. What was is the issue of principle again was the issue, whether you're entitled to increase it at all, not necessarily the amount of it. But as I say, I can come back to that. I've almost finished on this one. In looking at the annual increases, so looking at the table and the effect of that, we say, because of the way it was pleaded, because of the absence of evidence by the appellant, because the appellant didn't challenge the evidence of Ms. Chatlani about the schedule of rates and what they were based on and how they tied in with the table, we say none of that really featured in the argument before the first instance judge, and consequently she made no finding in the first instance judgment that the table of guaranteed cost of insurance charges had been omitted from the policy and never been provided to the appellant. There's just an absence of finding. And seeking to suggest that the absence of a finding is a ground to question or criticise the judge's judgment is, we say, misplaced. She addressed the issues as pleaded, and she worked on an inference that in the absence of any challenge, actual rates charged were in accordance with the policy. That is the inference we say has to be read into a judgment in the absence of any specific challenge in that regard.
It doesn't say that expressly.
She doesn't say that expressly.
Well, she gets very close to it in paragraph 67, where she says in terms, the increases in the GCOI were justifiable under the policy.
Yes, that's the passage I was going to take your lordship from my lady to. That is there. Therefore, the allegation that the GCOI is a fixed amount and that its subsequent increase was done unilaterally by Colina is ill-founded, and it follows the increases in the guaranteed cost of insurance were justified under the policy. So she in those two sentences, she's addressed the issue that was the issue before her, and in the absence of any other issue as to the actual increases applied, it followed that the increases were justifiable under the policy. And
So you accept she's making a logical jump there, but you say, well, the jump was justified because nobody said don't make that jump.
Yeah. Precisely.
And if she wasn't logically entitled to make that jump, then there was, she just didn't know whether it was justifiable under the policy. Your argument is, forget about the burden of proof.
Yes.
Because really, frankly, this is all about the issues that were raised at the time. Okay. And on the basis of the issues that were raised, she was entitled to come to that conclusion. Okay. If the issue was raised, was she entitled to come to that conclusion? That is, the increases in the GCOI were justifiable under the policy.
Yes. Yes, she was.
She would have to apply the table and schedules.
There would have to be some evidence adduced that they were not justified, that they were not the rates applied in the table from the appellant. That has to be the starting point.
And what sort of evidence do you anticipate the appellant can produce to that effect when he hasn't got the table?
The table was never provided to me.
And the schedule was never available and so on.
Precisely that.
I mean, what evidence could he produce?
He could have said in his witness statement, I was never provided with the table. I can't vouch for those sums because I was never provided with the table. I don't know what tables you're using. I don't know if those are justified.
And you said because he didn't say that, but he never accepted that he had received a table, that sort of makes all the difference, does it? Or are you saying that there was some evidence from which the judge could infer that the rates charged, in fact, were either those set in the table or less than those set in the table?
Yes, well, it's the inference from Ms. Chatlani's evidence as to how they were applied. And she explained that they were applied having regard to the attained insurance age of the appellant in a schedule of rates. So Ms. Chatlani gave evidence that the factor that was being applied was the relevant factor.
Yeah, but not that the schedule was the table in the policy.
No.
And so how do we know whether it conformed with that or not?
But that
you say it had to be a maximum, and the judge could assume that it was less than the maximum. Is that the point?
Well, I do make a point in relation to that. What are the consequences if there were no table? But the evidence is the rates applied were applied in accordance with the attained insurance age, in accordance with the respondent's usual practice, in the course of the practice of the company, in the ordinary way. And I say that, in the absence of anything else, is a sufficient basis on which to determine that or make a finding that the rates applied were applied contractually, but by the insurance company.
So when one is dealing with a business which involves making many millions of adjustments to many hundreds of accounts, the insurer or the bank is never going to be able to produce someone who says, oh yes, I remember 30 years ago I pressed a button that said send this or deduct that. The evidence is this is how our business is run. These things are sent out, these are the basis on which deductions are made, and there's nothing to suggest that that wasn't done in this case.
Yes.
Until somebody says it wasn't done in this case.
Because it's a computerized system,
Yeah.
someone would have set up the system to apply these increases. I don't think anyone physically presses a button and then there's an increase. I think you program the system, I would imagine, you have the policy, you program the system, it then affects the changes.
Well, I mean, that's useful, because I was looking at page 27, and the last increase on the 9th of August 2014, and I would have thought that in 2014 it would be a simple matter of asking whoever it was who made that increase, how did he come to it? You know? But you say it's a computer.
These figures are taken from...
They're taken from a computer, but are they inputted by the computer? Or does a human, well, I mean,
The company obviously must have in 2014 some schedule of rates that it's using.
I'm sorry, Mark.
The company must have a schedule of rates in 2014 that it's using.
I'm sure it does.
Or did.
Yes.
It's not just the computer, it does everything. I mean, it only does what it's told, as it were.
Yes. I mean, so someone would have to program it, would have to tell it what the rates are that are being used in that particular year. Absolutely. Yes. I accept that.
Yes, well, one can see what was going on fairly clearly from page 533, which is the insurance company's letter, where we see the annual guaranteed cost of insurance changing. And other than the anomalous year 4, which I think is the reinstatement hike, as it were,
yes.
You see each year the increase being between about 7.5% and 9.8%. So you see a consistent pattern
yes.
of increased charges per annum. Yes. But the thing that sticks out, which is the point no doubt you're coming to shortly, yes. is how the 2006 increase was contractually justified.
I'm conscious of the time. I want to move to that. Can I just make one final submission in relation to the consequence of the absence of the table, if that's what it was? We say the suggestion by the appellant that in the absence of a table, parties are to be taken to have agreed a fixed rate is illogical and unfounded. Based on the clear wording of the policy illustration, and the market understanding of universal life policies generally, there can be no doubt that the parties intended for the yearly renewable guaranteed cost of insurance, in this case to increase annually, having regard to the appellant's attained insurance age.
So what, do you say it should be interpreted that if, suppose there was no table, just because that's the assumption you're addressing, that it should be inferred that the rates were whatever the standard rates were that the company had in 2003, which could be ascertained
yes.
for a person in that category?
As a matter of the agreement between the parties, we say the consequence of the absence of the table is that there were no maximums. That would be the first point specified. But in any event, leaving that to one side, precise the point, the respondent would have been entitled reasonably to increase the guaranteed cost of insurance, having regard to the appellant's attained insurance age. That was the relevant factor, and the contract would be interpreted as allowing the respondent to apply reasonable increases, which is an objective standard and reviewable by the courts if there were any dispute on the matter. The appellant, at least in his written case, seeks to pray in aid of authorities where the purported contract is too uncertain for there to be a binding agreement at all. But those authorities, in particular Willis Management, we say misses the mark. But it's a useful authority because it indicates where there is no agreement So, for example, in that case, the parties had agreed to negotiate a fair share. One party was going to pay a fair share on principles to be discussed and agreed. And that's too uncertain to be enforceable and binding as a contract. So the court regarded this as too uncertain to be binding, since there had been no further discussions or agreement as to the basis on which the fair share would be calculated. But that's nothing like the position here. The principle underlying the increase, the annual increase in the rate, is clear. It's the appellant's attained insurance age.
Yes, but you don't know whether the fact that he's got one more year on the clock, whether that means that it should go up 1% or 10% or 20%. You've got to have some kind of schedule or table to tell you what an extra year of age equates to in terms of increase.
So
you say you would look at the schedules in the company generally, that it was applying to people in the risk category of him, and the fact that he, as one insured, didn't get that, you would just look at a similar person and see what table they were sent and import that across, or something like that.
Well, my lady, it's more sophisticated than that, because there are actuaries who work for recognised bodies who produce standard form tables of mortality. And so if you're trying to assess whether the rate applied by the company in its schedule for any particular year across the board is a reasonable rate, there are objective criteria by which you can assess that. Let's say, if I had a moment, I could find that there is a reference to a body of actuaries who produce a standard form table.
Yeah, there are standard tables, like tables.
And they produced one in 2005, and then it's updated in 2008. And so that comparison is possible. It's not just having to look at whether this company is acted differently compared with another company. There are standards out there which can be applied.
I mean, we don't know if the Canada Life was using the tables for the United States or for Canada or for the Bahamas.
Not the exact geographical region, but it would have been the North America, because that's the location in which these policies were issued. And again, it is a North American body of actuaries who produce standard rates for those in North America. So it could all be done. It can all work. Yes. Sorry, my junior, Mr. Bailey, very helpfully is pointing to 1451. The reference I had is, in fact, in Black and Skipper, the book on life insurance. The edition that we've got in the bundles of the book is 1987, but on that page, in the full paragraph in the left-hand column, it says most insurers base their maximum mortality charges printed in the policy on those derived from the 1958 CSO mortality table, a conservative valuation table. Increasingly, insurers are adopting the 1980 CSO table as the basis for their contractually guaranteed maximum rates. And then it continues. I say that was the position when the book was written in 1987, but clearly the CSO are producing mortality tables from time to time, standard mortality tables, and the practice is of insurers to use that table when setting their maximum rates.
What's your headline point on this branch of the case?
The headline point in relation to this part of the case, which is issue 1, whether the respondent was contractually entitled to increase annually, is yes, the respondent was entitled to increase the cost of insurance annually, was entitled to do that. We say on a basis within its discretion, but within limits, and the limits are set out in a table that was attached to the policy, which would have been based on standard limits. And the issue that was before the judge is whether that was an annually increasing was permitted, or whether it was fixed. And the issue, having regard to the issue, decided it was annually increasing. No one was looking at whether on that basis, assuming that finding, the actual charges applied were permitted. That just didn't crop up. The judge, in making her finding, that the actual charges applied were contractually permitted, worked on the inference that in the absence of any other challenge, they were permitted. And that inference, we say, was justified. It was justified on the basis of the evidence and case that was before her.
And can I just ask, was the maximum argument that you're making that these figures were maximum, was that your client's case in front of the judge as well?
Again, I don't, because the table never cropped up, that question never cropped up, no submission in relation to...
But there were questions about what rates were applied.
Yes.
And there was findings about that, and
Yes.
your client's witness didn't know. But you might well have had a case as to what rates were meant to be applied. In fact, I would expect you to do so.
Yes, so again, the client, what she was being asked is how do you actuarially calculate whether it's...
No, I'm just talking about the contract,
Yes.
whether the rates in the table were meant to be maximum rates or whether they were meant to be agreed rates.
Yes,
And you've made a submission that they're maximum rates.
yes, and
All I'm asking you is, has that always been your client's case, or is it a new case presented to us? That's what I want to know.
it's a new case presented in response to a new argument, because this particular argument was not raised below.
And so you say this point, this question at all wasn't raised below?
This question at all wasn't raised below, nor indeed is it in the notice of appeal.
But I think that if you've got maxima, then one would imply in that if the insurer wants to increase it by less than the maxima, then that's permitted. It's not going to be a breach of contract
Of course.
for the insurer to increase the premiums by less than they're contractually entitled to.
And of course, these policies are all working within a dynamic market. I mean, there are going to be tables out there comparing products. So insurance consultants are going to look at, for example, what rates does one insurance provider apply by way of credit interest as compared to another. Because again, there's a guaranteed rate and there's a maximum rate. But as long as you get the guaranteed rate, you can say, well, I've satisfied my contractual commitment. But there will be, the insurance advisors will look, well, 3%, but you could do better at 6% with someone else. And the same with the charges. There are going to be comparisons out there as to where you fall in. So it's not just a question of, well, the insurers can make the maximum profit by pushing it down as long as, or pushing it as close to the maximum. They've got to sell these products in an active market, and that's why they look at the performance of these in the round. So, I say I'm slightly conscious of the time, and I've got to deal with the reinstatement point, and that, as I understand it now, is really the question of construction, not the fact of the reinstatement, and that a plus 75% rating was applied, but whether that was justified.
The issue isn't whether or not there was a lapse or reinstatement in 2006. The issue is, what did the insurance company do in response to that lapse, and was there a contractual justification for that which they did? The first question is, how do we deduce 75% from the figures that are available to us? And the second question is, where's the contractual entitlement?
Yes, well, the contractual entitlement indeed was one that was identified by Ms. Chatlani in her evidence. She was asked about this. She was asked...
Yes.
She was questioned by the appellant about the plus 75% rating at trial. She was asked which provision in the policy entitled the respondent to impose the increase as a condition of reinstatement, and that's in the first instance transcript between 119 and 123. And in essence, what Ms. Chatlani referred to was the reinstatement clause in the policy, which is at page 498. And as my lord and my lady have well in mind, this clause says that the policy, so we're assuming the assumption, the starting assumption is the policy has lapsed. It has come to an end. And what this clause does is give an option, effectively, to the insured to reinstate it. The policy may be reinstated at any time within 3 years, so the option to reinstate has to be exercised within a 3-year period after the date of lapse, if we receive the following. And so what this clause requires is the appellant in this case, the policyholder, to provide evidence of insurability satisfactory to the insurer, and that is defined in the policy at 493. Evidence of insurability is medical and other evidence provided with respect to any life insured that establishes to our satisfaction whether the life insured qualifies for insurance under our requirements. Now, just pausing there, my lords will recollect that under a universal policy, what an insurer can't do is, from year to year, is increase the premium, assuming it's not lapsed, increase the premium having to reflect any adverse physical condition. If the policy hasn't lapsed, all the insurer can do is increase corresponding to the increasing age of the individual. Now, what this first provision is looking at is addressing the former. Where a policy has lapsed, this provision, evidence of insurability for all lives insured satisfactory to us, allows the insurer to look at and re-rate the risk having regard to any adverse physical condition.
But there's no evidence that, in this case, there was any evidence required or unsatisfactory.
No,
I mean, that condition just not relevant here, is it?
Well, given that we are not requiring you to consider whether or not there was a lapse in the reinstatement, we're taking the reinstatement as a given.
Yeah.
The real issue is paragraph 5.
Yeah.
Yeah. Of page 498.
Well, yes, it's the combination of the two of those. So what we say, what we have, and we've seen from paragraph 10 of the defence, is evidence of the fact of the reinstatement and the payment of 3 premiums. Mm-hmm. And what the evidence was wasn't directed to how did you get to 75% so much as to the entitlement. And here the entitlement was pointed out, it's under these two provisions, 1 and 5. And I'd say medical evidence effectively established to our satisfaction whether the life insured qualifies for insurance under our requirements. And it may be that the medical evidence produced would qualify for insurance under the insurer's requirements, but only at an increased premium. So because this is the point that I'm not making a factual submission, I'm taking in terms of how that provision
in theory
works in theory. And so in theory, if there has been a deterioration in the physical condition of an insured, mm-hmm. and the policy has lapsed, then that can be taken into account. And the insurer can decide that because of the deterioration in the physical condition of the insured, you qualify for insurance under our requirements, but only at an increased premium. And that ties in with number 5, any additional company requirements in effect on the date of the application for reinstatement. Because again, what's being applied effectively is a new application for insurance insofar as the physical condition of the policyholder is concerned.
I didn't quite read paragraph 1 in that way. And I thought it gave the insurance company the option of saying, it's not satisfactory to us, we're not going to reinstate. Mm. And if you want a new policy, well, go along and propose for a new policy. I mean, that's and perhaps I've got that wrong, but that was my reading.
Well, it may be, as I say, it's looking at the. I'm focusing in a sense on or reading in the words of the definition into one. So medical evidence. So this is medical evidence of insurability. Must be provided to our established to our satisfaction whether life insured qualifies for insurance under our requirements. And I think the point my lord is putting to me is, well, either the answer is yes or no to that.
That's right. Yeah.
And I'll submit that
you don't increase opinion. You just say yes or no to
either you can reinstate or you can't.
Yeah.
Well, I would submit that the answer is not one or the other. It is a spectrum.
But these are things that it has to receive, the company, in order, as I read it, the insured has a right to reinstate, subject to providing a list of things. One of those is evidence satisfactory to the insurer, then there's money that has to be paid. But 5, if it's going to be a sum of money, it's got to be a sum of money that he knows he has to pay in order to reinstate.
The answer to that, yes.
I mean, because he's got to pay it, he'd have to pay it in order to reinstate.
Yes. So a precondition
Yes.
to reinstatement is the payment of an increase of the deduction of an increased cost of insurance.
So what? And agreement to pay that in the future as well? Is that a precondition? Or is it to make a payment in advance of a certain amount?
No. It is to look at. So this is going to take 2 scenarios. One is there's been no change in physical condition. That's pretty easy, assuming the insurer is still writing the business for the same people. It's going to reinstate on the same terms. And in this case, the findings of the judge and the evidence below, there was a number of reinstatements, and often it was reinstated on the same terms. If there has been a deterioration in a condition, the second scenario, then what this is looking at is it certainly does give the insurer the option to say, we don't want to insure you at all.
Well, then there's no reinstatement.
But then there's no reinstatement. What this is envisaging is a midpoint, that there is a reinstatement, but on terms that are satisfactory to the insurer. And that means because you're we want to increase the premium not just because your age is going up, but because there's been a deterioration in your physical condition.
But then you don't have the right to reinstate if they say no. I mean, it's either a right to reinstate or you don't.
Oh, I see. So well, what this is doing is saying after 3 years, the policy is finished once and for all.
No right to reinstate.
No possibility of reinstating.
No.
Before that, the policy may be reinstated. Now, that envisages that the policyholder applies for the policy to be reinstated. Got to ask for it to be reinstated, so there's a step taken there. And
do you say there's a discretion there on the part of the insurer?
there is a discretion there on the part of the insurer because the evidence, the medical evidence, is got to be
but do you say that the word may
yes
means more, because I interpret the word may, would do so that provided all these conditions are satisfied, the insured is entitled to reinstate the policy.
Well, it doesn't say shall.
That's right. But
Let's suppose when by the time the policy lapses, the insured has been diagnosed with a terminal illness. And the insurer does not want to provide life insurance. They refuse to reinstate, and then presumably all the premiums are forfeit, and he's never going to get life insurance from anybody else now. Another in between that and there having been no change is that he has had some illness, or he's had some discovered some genetic issue that doesn't mean that he's definitely going to die sooner rather than later, but creates the risk, and it might be more difficult for him to get other insurance. But if he can reinstate this policy, he is, I would have thought, in a better position than starting from scratch with some new insurer, because then he's got all those paid up premiums which have some effect, which he would just forfeit if he had to go to a different insurer. So it is, but they might still want to insist on a higher premium because he's just more risky now because of what they know about him.
Yes,
that's what I've thought it.
And that, in a sense, better explains what I was trying to drive at, that there is a range of changes in physical condition that can occur, and what this clause, properly construed, is not saying if the insured applies, the only option for the insurer is to take it or leave it, wherever in that range of change of physical conditions it might be. The may be reinstated is if the medical evidence is satisfactory to the insurer, and if the increase accordingly is satisfactory to the insured, then the policy may be reinstated on those terms.
But do you say that the insurer has some discretion over whether the policy is reinstated, other than saying whether the evidence provided is satisfactory? Do you say that do you say reinstatement is something that the insurer does, as opposed to something that the insured does?
I don't think I go that far. I think I'm saying that the may recognises that both the insured and the insurer have to do something for the policy to be reinstated. The insured has got to apply in the first instance. The insurer has got to be satisfied with the medical evidence and prepared to provide insurance under its requirements, which may be an increase in premium, and the insured has got to be happy with that. And so the may...
And may the increase in premium be irrespective of whether there's any change in medical condition? Or does it have to be related to medical condition?
It's the medical condition. It's the medical condition, because if you look at what this is, I say, in a sense, I think of the dictionary definition, which is helpful in saying what can't be done when a policy has not lapsed. You can't look at medical condition, you can only look at the age. Now, the converse of that is the policy has lapsed, you can look at medical condition. And what this is saying is precisely that. We can look at your medical condition. We can look at your change in medical circumstances. And we can decide whether it's satisfactory to us and qualifies for insurance under our requirements. And our requirements can be, we will insure you with that medical condition, whether it's one or the other or somewhere in between, but on this rate. And if that is acceptable to the policyholder, then the policy will be reinstated. So I read may as being involving both parties rather than imposing an obligation on one or the other. I think it does involve that, but it's directed. This provision specifically, paragraph 1 of the reinstatement clause, is directed to the medical condition of the assured, which ordinarily cannot be taken into account, but under this clause is making it clear that it can be taken into account.
But there's absolutely no evidence. I mean, it's an interesting argument about the proper construction of Clause 1, but there's no evidence of any medical condition leading to any increase.
Well, the only evidence on this point was from Ms. Chatlani, not evidence of fact this is what happened, but as to what the practice was. And she was saying things like, you to Mr. McPhee would have submitted a medical questionnaire. So in terms of practice and how the clause was meant to operate, or understood by at least the respondent to operate, there would be the provision of medical evidence, and it would be assessed by the actuaries on that basis.
Was there any additional company requirements in effect on the date of application for reinstatement? And if so, where do I find it in the bundle?
Well, you won't, my lord, is the answer.
Yeah. Do you rely upon Clause 5?
Yes. I rely upon Clause 5 because Ms. Chatlani's evidence was that the reinstatement, which occurred in fact in 2006, and the increase, what she described as the plus 75% increase, plus 75% rating increase compared to with the original, would have involved a consideration of the medical evidence, and that being assessed and rated by the company. And the result of that was this plus 75% rating.
And so her evidence justified, and it's an inference that an application was made, medical evidence was provided, medical evidence was found that the claimant's condition had deteriorated, and then some rate was applied as a result of that, and all that factually happened.
Well, again, she couldn't herself say what factually happened because she wasn't there. She was.
And you couldn't possibly found that factual inference on her evidence, could you? Did all those things happen?
The inference from the fact that there was an increase in the dollar sum following a reinstatement justifies the inference that the clause that she pointed to, which is the clause dealing with reinstatements, and which, on her evidence, would be the clause that the company, as a matter of practice, applied.
So you say yes, that the evidence that the justification would only have been justified if there had been such evidence, means that because a charge was raised, the claimant must have had a deteriorating medical condition, he must have submitted evidence of it, and that evidence must have been found to justify an increased rating. And all that was a proper inference that a judge could draw off the company's practice.
It could be suggested that was slightly circular.
Well, I was rather thinking. Again, can I just go to what she said at page 119, just so we've got it. This is the transcript from first instance. And it's page 119, and it's really starting, I think, from line 15, where the appellant asks Ms. Chatlani, where in the contract does it authorise you to charge a plus 75% rating? She identifies the reinstatement clause. And then a bit further down, towards line 29, so with regard to the evidence of insurable, there are 5 stipulations. So under the context of those 5 requirements, or those 5 terms, we're allowed to reassess the risk, the health risks of the individual. And based on that, we have determined additional 75% rating is required in order to continue. How is that calculated? Our underwriter would calculate that based upon you filing your health statement. What was that number or figure that I would have to pay for that 75% rating? An additional 75% of your premium. And then
Well, that doesn't make sense, does it?
It doesn't, looking at the figures that we've got. But but we know the answer. What is the figure we can see in table 10 of the amended defence? How is that communicated? In line 17, you would have reinstated, or when was that communicated? When you would have reinstated the policy, that should have been communicated to you. So that is all practice, but that is the practice of the company. The company, if a policy lapses, ordinarily the policy is lapsed.
Did they go on to put to her,
yes,
actually there's no evidence of him having filled out a health statement?
Yes, and then
these questions are being asked by Mr. McPhee.
they are.
So she says at 5, our underwriting would calculate that based on you filling out a health statement. But was that ever pursued?
Yeah. Well, she goes on to consider it, but in terms on page 121. If you're line 6, if you're referring to the fact that we can, at the point of the reinstatement, request additional rating through the terms of the reinstatement, whether it would be evidence of insurability and any other additional company requirements, we can, at that point in time, request an additional rating on your policy. And accepting the reinstatement, which you did, you would have agreed to that. Your premium would have increased, and so on, and that would have been communicated to you.
Although she says, I'm not aware of any contest from yourself with regard to that.
No, and that, my lady, is where I was getting to. Really, the point is this: we're looking at the evidence that was given at the first instance trial at a time when there was no issue as to whether the policy had lapsed in 2006 and been reinstated on that occasion.
But there was an issue as to whether the uplift was justified, and you can't expect Mr. McPhee to turn up with a trial to say, with addressing a justification that he doesn't know until he gets an answer in cross-examination pointing to a clause in the policy that had never been mentioned in the pleadings or up to that time.
Well, just in relation to the pleadings, perhaps it's important just to take that, just to have a look at this. I appreciate my lords, my lady will have this in mind, but the appellant's writ of summons, which includes the statement of claim, starts at page 4, and you have a look at this paragraph 10 at the top of page 6. The appellant as the plaintiff said, the plaintiff asserts that if a premium ever went unpaid and the policy lapsed, he had it reinstated within a week or so upon such notification. And we said that although somewhat obscure, the only sensible way to read that paragraph is that the appellant accepted that the policy had lapsed in the past, but contended that when it did, he had taken steps to reinstate the policy within a week of notification. And that is at least how the respondent understood it. If we look at paragraph 8 of the amended defence, which is page 18 in the bundle, and this is the context in which this arises, the defendant admitted that the plaintiff's policy lapsed, as is alleged in paragraph 10 of the statement of claim. Such lapses and reinstatements of the policy occurred on the following dates, and then a list is provided. Not admitted that the plaintiff had the policy reinstated within a week or so, being notified that the policy had lapsed. So lapsing and notification of lapsing. And then in paragraph 9, the respondent proceeded to explain that when the policy lapsed in 2006, a plus 75% rating was applied thereon, which effectively increased both the premiums and the guaranteed cost of insurance relative to that in the original policy.
What's that mean?
Sorry?
What does that mean? It didn't increase the premiums at all. The premiums stayed the same.
Certainly, the amount of premiums that were paid stayed the same. I don't know, because it wasn't explored with the witness, and she didn't expand, whether the target premium.
You can pay whatever premium you want as long as the account it's got enough money in it to pay the monthly deduction.
You can, and one of the criticisms of universal life policies, because you have that freedom, that choice, is that a policyholder may not appreciate that he's got down to zero and his policy is going to lapse. And so one of the ways of addressing that problem is by having the target premium. If you pay a target premium, then that will be the minimum to keep your policy alive for a certain period of time. And you can rest assured if you pay that premium, your policy will remain alive.
I'll have to ask you to bring your submissions to a close,
Yes.
given the passage of time.
I do apologise. So just bringing the point I was making finally here is that is where the pleadings rest. And when my lord asked me, well, what was the disclosure? The disclosure was given, and the witness evidence was prepared on the basis of those statements in the pleadings. The challenge, in fact, came in the appellant's witness statement. It's at paragraph 30 and 556. He said there's no adverse consequences or penalties provided for in the policy to increase premiums payable or the guaranteed cost of insurance in the event of its lapse. It comes in his witness statement. And then he, of course, the points are taken at trial and explored to a certain extent at trial as a matter of construction. But to the extent it said, well, where are the documents from 2006? Well, the lapse in 2006 was taken to have been not an issue. The disclosure wasn't provided in relation to 2006 because it wasn't taken to be an issue. The medical evidence that Ms. Chatlani expects as a matter of company procedure to have been provided and so on wasn't disclosed because it wasn't taken to have been an issue. So that is how the issue arose at first instance, and that is the context in which Ms. Chatlani was being questioned, and which she gave her evidence. Her witness statement repeats that the plus 75% rating applied. There was the lapse, the rating was applied. It didn't go further because there wasn't an issue on the pleadings at that stage. And so the question is, well, where is all the evidence? Well, it may well be out there, but it wasn't seen to be relevant to the issues on the pleading. And that is really the point I was trying to make, that the only evidence that Mr. Chatlani could do in the witness box when presented with these questions is to give evidence as to the company's practice and procedure. And her evidence as the practice and procedure of the company is to acquire medical evidence, particularly when there's an increase, which there was an increase in this case on reinstatement. Now that is the proper context in which to approach the evidence we would submit. So I'm very conscious that I probably need to wrap up there.
You do. So if there's anything fundamental still to be added, please do so very quickly.
No, I think I've trespassed on the court's indulgence enough, and I shall sit down.
I'm most grateful. Yes.
Sorry, before you do, page 207. One of the propositions you said there was no appeal in relation to the annual increase of the guaranteed cost of insurance. But at page 207 at the bottom, and over the top to page 208, wasn't there an appeal? This is the notice of appeal to the Court of Appeal, isn't it? And doesn't that raise the issue?
So the learned judge was wrong in law when she did not dismiss the defence, as the respondent has no explanation for all the financial and cascading discrepancies in the annual policy statements.
And did not know how the increase was calculated.
So, my Lord, that is directed to two different points. One is the annual policy statements, which I've not relied upon at all on this appeal. They were found to have been sent to him, and from those you can see the annual increasing amounts. How the increase of CGI was calculated, that is directed to the questions that were put to Ms. Chatlani, is exactly how do you get to a dollar figure? In other words, what would the actuaries have done? Her answer is, I don't know how you get to $74.62 in the original policy, so I can't tell you how you get to $80.25 on renewal. All I can tell you is there's a standard schedule of rates. And what this is saying is the judge was wrong not to dismiss the defence.
And the attorneys who wrote these grounds of appeal weren't the people who presented the appeal for the Court of Appeal.
Well, they started.
They started, but then their client took over.
Yes, and also in that context, it's relevant to note that the grounds of appeal were distilled down by Mr. Edwards as counsel before he was stood down, and the appellant took over, and the appellant maintained the distillation, as it were, of the grounds of appeal into 2 or possibly 3 or possibly 4 in the end. But all these numerous grounds, well, in fact, I think this is a shorter version of what was before the Court of Appeal. I think there were some 52 grounds before the Court of Appeal, and they were distilled down. So looking at this document, which I don't think is the final document, and the 52 grounds which was distilled down, I don't think really takes us very far. My submission.
Thank you. Yes, please.
My Lord, yes, just picking up on this 75% increase. It's not only that there was no evidence that Mr. McPhee had undertaken any kind of medicals, not only that, it's the fact that Mr. McPhee was never asked in cross-examination. So when Ms. Chatlani says at 120, page 120 of the transcript, our underwriting would calculate that based on you filling out a health statement, one would have thought that there would have been cross-examination of Mr. McPhee. And Mr. McPhee, the question would have been asked of Mr. McPhee, well, you signed...
Mr. McPhee doesn't challenge that answer when she gives it. Why would you then challenge him? He's not saying... No,
my lady. The point that I make is Mr. McPhee has already been cross-examined. Mr. McPhee has never been cross-examined, and it's never been asked, well, Mr. McPhee, you filled in some medical forms or had a medical, and in fact, that medical showed a deterioration in your medical condition. justifying the insurance company imposing 75%. That was never asked.
Why would you ask that if he's not
Because,
challenged it?
well, because no, my lady, if the insurance company is going to justify 75% on the basis that Mr. McPhee's health deteriorated, one would have thought that the insurance company would cross-examine Mr. McPhee on that and ask him, well, you submitted medical evidence. That medical evidence showed that your medical condition deteriorated. None of that was ever asked in cross-examination. And indeed, no evidence was adduced by the insurance company that Mr. McPhee's medical condition had deteriorated. None at all. There could have easily been disclosure of documents, for example. None of that was done. And of course, Mr. McPhee as well, at page 121, at the bottom, when he cross-examines, he says at line 28, was that communicated to me before? He says, that should have been communicated to you, but it was not. North, you can't give evidence from the bar. Mr. McPhee, I am putting it to you that the owner did not get notice that the premium would be increased by 75%. I am not aware of that, she says. So there's two parts in terms of a gap in the evidence. It's the evidence that his condition, the medical condition, deteriorated, but also that it was then communicated, the 75% was communicated to him such that he would have agreed to the 75%, because throughout this case, it's clear beyond peradventure, in my respectful submission, that Mr. McPhee is saying, I never agreed to this 75%, how on earth are you charging this 75%? That's all I need to say in relation to the 75% increase. But I want to now, just very briefly, respond in relation to the guaranteed cost of insurance. And my learned friend, essentially, his submissions amount to this. He says, well, there would have been a table that sets a maximum, and below the maximum, the insurance company has a discretion as to how much to charge in terms of the guaranteed cost of insurance. Actually, as a matter of construction, I remind you, Lordships, at page 500 of the bundle, it says the monthly guaranteed cost of insurance is 1/12 the rate shown in the table of guaranteed cost of insurance charges at the end of this policy. Is. This is the document is not talking about maximums. Is, that's the wording that is in fact used. May I also take your Lordships to page 195, paragraph 56 and 57 of the judge's judgment. And it can't be asserted that none of this was at issue in relation to the guaranteed cost of insurance, how it's calculated and all the rest of it, because the judge herself records the dispute. At 56, she says, Mr. McPhee argued that the guaranteed cost of insurance is a fixed amount and that its subsequent increase was done unilaterally by Colina. He further argued that the increases in the guaranteed cost of insurance are not justifiable under the policy, and that he's entitled to a finding that the overage of $8,000 is to be credited to his account. Then at 57, Mr. McPhee further argued that Colina cannot demonstrate any formula as to how they calculate the mortality charge, which in any event is not a term in the policy. And that, of course, must be a reference to, well, there's nothing in the contract that in fact allows the court to calculate this. And it goes goes back in my submission to the absence of the table, of course, if one reads the contract, and all my submissions have been premised on that basis, one reads the contract, as my learned friend and his clients have read it, that it's a question of envisaging an increase. May I also take your lordships as well to an authority? Of course, I say that all these authorities about universal life, they're all terribly interesting, but at the end of the day, this case turns on the contract and the absence of evidence, lack of cross-examination, etc. But let me take your lordships to page 1444. And it's on the nature of universal life insurance, because it does make out, it does echo a submission that I made your lordships during my introductory observations. And your lordships will see, nature of universal life. The universal life is a flexible, premium, adjustable death benefit life insurance policy. UL offers flexible, potentially low-cost coverage on the basis that permits product transparency. After making an initial premium payment of at least some required minimum, policy owners may thereafter pay whatever amounts at whatever times they wish, or even skip premium payments as long as the cash value will cover policy charges subject to a company's rules and tax law. Also, policy owners may raise, usually subject to evidence of insurability, or lower their policy's death benefit as they deem appropriate with the minimum difficulty. These are the key elements of universal life flexibility. And then the next, not the next paragraph, but the beginning of the next one. Universal life policies are I beg your pardon?
Page?
1444.
1444. Universal life policies are transparent in their operation. The policy owner is able to see exactly how the policy operates internally. But of course, that's the complaint that I make in this appeal. That it's not transparent, and all the submissions that my learned friend has made in relation to the use of the rates table schedule by the insurance company, in my respectful submission, just simply demonstrates how lack of transparent this was, which is the antithesis of how these types of policies ought to operate. Now, my learned friend also made a point about the production of the original contract. I just want to take your lordships to page 369. Is it 369?
Part of a transcript, is that right?
The transcript. Yes. So essentially, the policy, the original policy is produced to the Court of Appeal, and Mr. North then at line 15, he says, well, the judge says to Mr. North, does that address the concerns I think you have, from Mr. McPhee? I don't know that we had any concerns with in other words, Mr. North had never expressed any kind of concerns with the policy that had been, the copy of the policy that had been disclosed by Mr. McPhee. And then the judge says, so why did we want to see the original? Actually, the answer to that is because they wanted to see the original. Mr. North says, you all wanted to see the original after you discovered there were some missing pages. Jones was quick to point out that you have got missing pages. We want to see the original. It wasn't me, my lords. Very well. And there is a reference that I want to take your lordships to, and I hope that I have it at my fingertips. Well, I obviously don't have it at my fingertips, but it's the... In the Court of Appeal, I just don't have the reference, but in the Court of Appeal, Mr. McPhee essentially says, when this issue of the contract essentially, yes, it's at the top, 352 at the very top. So they're talking about pages 14 and 16. And Mr. McPhee says, right, they are not produced by Canada Life, just as the table of guaranteed insurers wasn't produced. They didn't produce that as well. And that's the second reference that I've taken your lordships to, of Mr. McPhee in the Court of Appeal, telling the Court of Appeal they never produced the table. It just wasn't. It wasn't annexed to this contract.
Yeah, but this is a submission in the Court of Appeal. It's not evidence at first instance.
No, it isn't. No, it isn't. But I emphasise the point as well. Of course, I go back. I don't want to try your lordship's patience by repeating points, but I do believe that it's important to point out that Mr. McPhee, it was never suggested to Mr. McPhee that somehow he was aware of the rates that were being applied by the insurance company, that the rates were the same as the table, that he had the table, for example, and that somehow he was coming to court trying to pull the wool over the none of that.
We just saw the later passage where he does produce this, and then they're saying, oh, well, there are missing pages. Does it make any difference? He says, no, it's not relevant to anything. There's nothing. It doesn't matter that there are missing.
No, but he's not referring. He's referring to. It would take me a long time to demonstrate this, my lady, but they're talking about missing pages, not the table, missing pages, because they look through this and they say, well, but there's some pages that are missing.
Right. And then you say here he is talking about the table.
No. Here he's saying just as the table was not included, these pages were not included.
But he's talking about a table of contents here.
No, he's talking about the table of guaranteed insurances. That's what he's talking about. It says, just as the table of guaranteed insurance wasn't produced, they didn't produce that as well. In other words, pages 14 to 16.
Can I ask you a question which may be leaping way ahead, and I haven't formed any view about it. But if for instance, they haven't, the burden of proof is on the insurance company, and they haven't in fact established their case that there was an annual increase or the amount of the increase, it seems to be intrinsically unjust to then say, oh well, the figure stays at $74, okay, over the lifetime of the policy. And so are you submitting to us that we remit and allow the insurance company to introduce evidence about that, or as to the table, as to comparable tables, or that's question number one. And question number two, is this case now simply and purely restricted to the amount in the savings account? In practical terms, shall we put it in that way, in practical terms? Because on one argument, if they've incorrectly calculated the deductions, then the matter wasn't then they weren't entitled to lapse the policy. But the policy has been out of existence now for a decade, or almost a decade, and everything will have moved on and so on. And I would hardly imagine that your client was going to be stumping up all the back premiums. So there are two questions. What do you invite us to do? And secondly, is the claim in practical terms, and I would put it in practical terms to leave you a degree of latitude, in practical terms, to dealing with purely and simply the amount in the savings account?
My lord, the position is that if the insurance company was not entitled to charge these annual increases and the 75%, then of course there would need to be, in the first instance, see whether there can be some form of agreement between the appellant and the respondent as to whether a statement of account can be agreed, taking into account those two findings. That's the first step. In the absence of that, then it would have to be remitted back in order for there to be a determination by the judge or by local courts as to what the state of the account is, taking into account the decision of the board as to whether these charges. Yes. It's very difficult for either me or the board or anybody in this courtroom to essentially do the calculations or anything like that. It's just be impossible.
I don't think Lord Stevens was asking you. He was just merely wishing to find out what would happen if the board were with you. And I think from your earlier answer in relation to ground 3, this is now about whether or not the insurance company owes Mr. McPhee money, which was in the notional investment account at the time when they may well have lapsed.
In 2014.
The account has lapsed wrongly.
2014, yes.
Yes, so the question is, it's a question of whether or not Mr. McPhee is to be paid a sum of money plus interest on what he had in that account.
Well, but doesn't that depend on what the legal outcome is if you're right that they're not entitled to increase the premium? Because if the effect of that is that actually there was no contract, because it's clear that both parties intended it would be increased, but they failed to agree an appropriate mechanism by which it was increased, then if the contract actually never came into existence, then I'm not sure how one works out the state of account. But nobody's ever argued any of the case law that there is about what is the outcome if the contract fails for uncertainty. But is that what you're submitting, that the contract failed for uncertainty and there never was an insurance contract?
I submit that we fall back on the 74-64, and therefore either the parties agree.
But it's a matter, in your case, of arithmetical calculation.
Yes.
Because every entry that's more than 74, whatever it is replaced by that, and then you just re-crunch the number.
Exactly, and I would have thought that would be capable of agreement, and if there is no agreement, then of course it's got to go somewhere, and that's got to go back in my submission. But I don't submit to the board that essentially what we have is a contract that's uncertain, and therefore that really undoes the entire contract.
So how does it work then with an ordinary insurance policy? So suppose I don't have one of these universal life policies, I just have an ordinary insurance policy. I pay the premiums by direct debit. Every year they write to me to say, your premiums have gone up, unless you cancel, we're going to change your direct debit within 10 days. The policy runs on for 20 years. And then I say to them, unless you can provide me with the table that you provided me 20 years ago showing the mechanism by which this increases, I don't accept that you are entitled to increase the premium, and I want you to refund me all those increases over the years. Now, if they say, I'm sorry, we must have sent it to you at the time, but we don't have it now, am I then entitled to recover all those premium increases?
If you made your case out, you'd probably have a claim for restitution, of course. Perhaps unjust enrichment on the basis that the insurance company has had a benefit that you're entitled to recover. The question that's been posed to me has been, well, as I understand it, the practical issue of, well, if we're with you, what do we do? My answer to that is, that it ought to be capable of agreement between the parties. The question that my lady asks is a much more fundamental question in terms of, my lady, I don't agree, if that is what my lady is positing, that essentially the whole policy falls away for uncertainty. The increase may fall away for uncertainty. The increase, but not the, and we fall back on the $74 spot 60 something that it is.
I think that's a hard argument to advance when, in the context where there are contractual provisions showing that there was intended to be an increasing rate. I mean, to say part of it falls for uncertainty, but it becomes a fixed price, a fixed deduction, I think is a different sort of contract from the one that the parties entered into.
My lords, can I just take your lordships?
The insurance company could simply provide what was their standard in 2003, or give evidence along those lines, and the outcome of that would be you would be fixed with it.
Well, if this were remitted back, the way that I would fight this if I were there in a trial is still to say, right, okay, demonstrate. If I'm right in terms of the construction, and I've taken your lordships to the word is in that particular clause, if I'm right in the construction, and as a matter of construction, it's got to be in accordance with the table, then I would fight this case by essentially putting by making sure the insurance company demonstrates that the rates that they have applied are the rates in the table. And if they can't do that, there is no agreement in relation to any rates increase.
They don't have to produce the table. They can call evidence as to what would be likely to have been in the table. Well, if they've lost the table, they can call such evidence.
Well, that may be so. That may be so. That's an alternative way of that may be an alternative way in which the insurance company could approach it. But still, there needs to be that bridge between the rates that they applied, the evidential bridge between the rates that they applied and the table.
Well, it'd be quite unusual, and I don't think we'd be doing any favours to have a complete fresh trial in this. I would have thought everybody's had their chance, and either the evidence, who has the burden of proof or whatever, comes out one way or the other. We don't start all over again, I wouldn't have thought.
Well, my lord, my lords, and I accept that. And
well, given the sum involved, it's quite remarkable that we're here at all.
I beg your pardon, my lord. Sorry.
So, given the sum involved, it's quite remarkable.
No. Indeed. May I just take some your lordships to some further references? I'm not going to take your lordships' time.
You're running out of time. You've got
yes. Well, then I will. I'll refer your lordships to them. Page 147 to 148, cross-examination, where again Mr. McPhee is not accepting. He's cross-examining on how you've come up with these annual increases. And then page 357, line 18 to 358, 1 to 13. And that is, and that's the Court of Appeal to Mr. North saying, well, hang on a minute, how is this worked out, these increases, and how does the evidence, in particular the policy illustration, fit into that? My lords, that is my reply. I can't really assist your lordships any further.
Thank you very much. Well, the board is grateful to counsel for presenting the appeal and the response, and also to those who have assisted counsel in that presentation and the compilation of the documents. The board will take time to consider what advice they will humbly tender to His Majesty.